All right. Good morning, good afternoon, good evening, wherever you happen to be in the world. Welcome to our daily market commentary. Hope everybody had an absolutely amazing trading day yesterday. We're going to do what we do each and every day, looking at our futures markets, 10 to 12 different markets, educational perspective. I took a little poll yesterday of some of our Traders Army members, and I said, hey, would you rather have a video recorded version of the daily market commentary or live as often as possible? And the feedback was, make it live as often as possible. So we will continue to do live DMCs more frequently. I will tell you this, I'm not committing to live every day. I'll do my best to do some live sessions more frequently, but we will still have some that come out on the recording. So good to have y'all. Thanks, Jeremy. We are literally in the home stretch. The paint is drying behind me on the bookshelves, and we are just about there. So appreciate you noticing, Jeremy. I'm excited about it. So let's go ahead and get rolling. If you are new, do me a favor, click the subscribe button, hit the notification bell. If you are a regular returning viewer, there's a little thumbs up button down there. Hit that thumbs up button. That really means a lot. Helps the algorithms know that human beings are watching and paying attention. And if you would, share this out with other people. Let them know that we do this every day. Because I think we're going to start doing this as often as we can, a little bit more frequently in the live version. All right, let me go ahead and make this screen the right size so you can all see. All right, let's go ahead and get started with our S&P. Now, I will say this. I'm going to try to have a hard stop at 7:30. I'm really going to try to have a hard stop right at the bottom of the hour. That's going to be my goal, is to get that hard stop in place. Make sure you're using the chat box this morning, asking any questions that you want. There's a lot to talk about today. So we are up 25 points this morning in the S&P, but we've been unable to really get some strength in the markets. We've been unable to do so. You know, I've got this line here at 34.49, and this 34.49, for those of you that joined us in our live session Wednesday, or you were in our live trade room yesterday at Traders Army, we talked about the fact that this was our line in the sand. We have to get above this number in order for price to really be able to turn back to the bullish the bullish side. Now, why did I say that number? Because if we think about it, swing high, swing high, swing high, swing high, we get lower swing highs and lower swing lows, right? Lower swing highs and lower swing lows is the definition of a downtrend. And so in order to get through that downtrend, in order for that downtrend to be over, what we would need is higher swing highs and higher swing lows. And we don't have any of those as of yet, right? None of those are happening as of yet. So without those happening, it's going to be a little bit difficult for us to really have much bullish sentiment. And so we were looking primarily bearish yesterday overall. So what are we looking for today? Well, what I'm looking for today is for price to continue its downward movement. Matter of fact, on a 4-hour trend, we had a little bit of a demand area down here on the 1 hour, but that demand area on the 1 hour, which was a fairly clean time of the day, we had rallied up throughout the day. We knew that this was going to be a pivotal area, unable to get through it as we tweezer topped there yesterday morning, had a little demand right through. So no surprise on there in that it came through, because there's really no entry on there. Now, what are we setting up for at the moment? Well, if I look at my 4-hour chart, we're setting for a pretty strong move down. Now, understand that we are looking at rollover, right? We're looking at futures rollover. And so if you decide, hey, listen, I think I like this 4-hour trade, I think I want to get into it, what I would recommend is you go to the contract-specific market, and you do it actually in the contract-specific market. So if you do it in the contract-specific market, what you're going to get is you're going to get a much better, cleaner picture and something that you can actually hold over the weekend. So if you go to the ESZ20, if you decide you want to hold something over the weekend. Now remember, what is our rule, by the way, when holding positions over a weekend? What is our rule when holding these positions over a weekend? We have to be very, very clear about that. If we're holding this S&P futures contract over the weekend, very good, Tom. We need to hedge that position. So if you have intentions upon holding it over the weekend, that has to be hedged. It has to be something that you account for. And the best way to hedge a futures position over the weekend is to utilize options. So if I'm in a short position, and let's say that I use a candle to candle trade and I get short below here with a stop above here, that would be our candle to candle play. And I'm short. And let's say that today we get a market that moves something like this, right? We get a pretty clean move down here. Let's say that we get a nice big candlestick like this, and we get, and we get another one that looks like this. And we say, you know what? I think this is going to continue down. I think we may gap down over the weekend. I'm going to take this position and I'm going to carry it. So if I'm in a short futures position, how do I hedge it over the weekend? How do I do that? For those of you that are familiar with that. Very good, Sean. You would use a protective call. You'd use a protective call. So one thing that's important to remember, if I want to hedge a long position, I buy a put. If I want to hedge a short position, I buy a call. It's the simplest way to do it. Now, which ones do I buy? Just go buy the next closest expiration, because the goal is that if I do this, I'm getting out of it on Sunday night. I'm not staying in this position any longer than Sunday night. The hedge is literally just a hedge. I'm buying short-term insurance policies. And what you're protecting against is a gap, right? What you're protecting against is a gap. And interestingly enough, especially when you buy, if the market gaps down, let's say you buy a call and the market gaps down, you're certainly going to lose money on that call, but you typically would make more money on the movement of the underlying security on the gap. Sometimes, though, with a big gap down, what else will you see with that options play? What else will you see with that options play if we get that big gap down? What's the other little kind of caveat that's going to happen? And it happens more with big gaps down than with anything else. Right? You're gonna get an additional little kicker, if you will. Okay, and that's my bonus question. If you by the way in the comments, let me know if you know. Very good. So Liz, Andrew, Steve, Josh, nice job. You get an increase in volatility. You get a spike in volatility, which then oftentimes you will have enough profit you'll have profit in the insurance and profit in the movement. So gaps down are actually a really, really interesting way to play if you want to hold it over the weekend. So that is a realistic setup and a realistic play. Now going back to my, let me go back to my chart with all my lines on it. We do have some demand down below us and some supply up above us, but the supply up above us, in order to get into that 15-minute area of supply, it's going to be these wicks up in here. I don't know that those are overly clean. They're very what I call wicky, and being very wicky, with the term that you'll hear me use is that it's thorny. There's a lot of thorns up there. And so I'm going to go a bit higher for now to this 15-minute supply area up here, which was formed yesterday morning, pretty decent time of the day. All right, the NASDAQ. So in our NASDAQ level yesterday, so we talked yesterday about a potential that we had some rejection at this blue. We anticipate at the 15-minute area. We anticipate a reversal. And that's exactly what we got, was a reversal out of that level. Now, it poked above the zone, but it stayed below our pivot, right? It poked above the zone, but it stayed below our pivot. So by poking above the zone, staying below our pivot, you know, that's plenty of wiggle room to stay in the trade and to ride that thing right down. So how many of you were able to catch that and ride that down yesterday? It wound up moving for over 300 points in the NASDAQ. Able to catch that thing and hold that down, and then it came right to our area of demand. Now, once again, where do we place our stops in these positions? We place our stops below those 15-minute, below the pivot level. Now, in this case, we hit this one in the very late afternoon, stayed above the pivot, and we got a little rally higher. This is why we use the pivots, but the zone were identified a bit higher. Nice move away from that area, but both of those levels need to move. Now, on my 4-hour, What's my 4-hour trend telling me right now about NASDAQ? What's our 4-hour trend telling us? My 4-hour trend in my mind is telling me that it's a really, really good day to work on your short game. If all you trade is the NASDAQ, it might be a good day to trade on to work on your short game. And that's because we have a lower swing high and a higher swing low. When we have a lower swing high and a higher swing low, then we are really just kind of coming together a little bit of sideways. It's definitely tougher sledding. It's a little bit harder trading in that environment. Not that it can't be done, certainly. But even when you go down to like the 15-minute chart, if I look at the 15-minute chart and I go up and I say, okay, well, where are my areas of demand below me? Well, let's look at current price and look down and to the left. If I look down and to the left to this area here, I've got a little bit of a move, right there. My chart's out of focus, Liz. Is anybody else seeing that? Let me know, and I'll see if there's anything I can do for it. Okay, so it's not me. All right. My connection looks pretty good on the stream, so I'm not sure what else I can do. It says I got an excellent connection, so. All right. So you know, looking below that area, we'd come a bit lower, and I think then you come all the way down here to the pivot. So on this, yeah, I know I'm on the 60. If I come down here to this pivot area, I have a little bit of a wick over wick area. Now this pivot area, oops, that's not what I wanted to do. Oops, that's also not what I wanted to do. I want to get rid of the circle. This pivot area here, not a great time of the day, right? Frankly, pretty horrible time of the day. But was the origin of a pretty strong rally in price, and it's a whole round number. So you could look to this area here for a potential reversal. If I move to the 15-minute chart, moving to the 15-minute chart, there is a little bit of consolidation in here where we may get a little reversal. This is one of the times where I'm going to take just the pivot itself as the area of demand. I know it's a little bit below that 11,000 mark, so you can give yourself some buffer here and go right there. But I'm going to put the pivot level in place for this one in case we make it down to there today. Now that's 259 points away in the NASDAQ. So if we make it down to there, this has to be a confirmation level. Breakdown at current price. Are you talking about on the 15-minute, Nathaniel, or on the 60 chart? And the reason I ask is because there's a difference. If I look at the 60 here, if I go off the 60, you're looking for a breakdown below this line here. If we get tight basing. Well, in order to get what I would consider tight basing, I would need candles of this size to form right in here, right? If I go to the 15-minute, then my candles can be a little bit bigger, but here's the biggest difference. On this, if I take the breakout on the 60, let's say we get quality basing. If I take the breakout on the 60, my stop has to be up here at the tightest. Now, in that case, I would anticipate price making it all the way down to my demand area down here. If you take the breakout on the 15, you're going to have a pivot right here that allows you to have a tighter stop. Now, what's the real difference on the 15 versus the 60, the tighter stop? Well, on the 60, you've got a higher risk in the trade because your stop is further away, but you've got a lower probability of getting stopped out, right? So you've got a higher risk, but you also have a higher probability to have a different style and what's okay with them. I'm okay with a breakdown. All of the breakdowns that I just talked about, though, are contingent upon getting basing right around here. And I don't know how comfortable I would be doing a breakout right at the open. So just be cautious of breakouts right at the open. Because breakouts right at the open tend to give me a lot more kind of whipsaw actions. All right, next, the Russell. So in our Russell level, hopefully some of you guys were able to catch our Russell level yesterday. This one worked out extremely well. We got a really nice move away. Price came into our 15-minute level, our 60-minute supply level, and then we got a confirmation short, and we moved away. We then came into our 15-minute demand level and got a little bit of a move away. So both the supply and the demand from yesterday's live trade room made entry in the Russell. Now, the good news is that was a good trade. The bad news is I got to remove those levels and start all over again because we traded all the way to the top of them. That being the case, looking at the 4-hour, in looking at my 4-hour position, what I'm going to look to do is to identify my trend direction. So what's my clear trend direction on this one? Clear trend direction is lower swing lows, lower swing highs, right? So my clear trend direction here is that price is going to continue to fall. So this is another one that if you wanted to go candle to candle, then you have an opportunity to get short on this thing. And so I would think that this is a good opportunity to go candle to candle short with a stop just above here and make this more of a bit of a longer term kind of swing trade, a bit of a longer term swing trade on here. I think this one makes really, really good sense. So if you're interested in this one, I think this is one that I would get short on. I like this one a lot today. Stop and go above here on a candle to candle setup. All right. Those are my equity markets. I'm going to throw the in the grid in. I'm going to share the grid here for those of you that pardon me as I'm working on two screens at once. All right, so the trade grid is in the chat box for you. Crude oils, yesterday's crude oil trade gave us a whole lot of nothing. We stayed in between our areas of supply and demand. Now, I will say that this is setting up for a pretty clean breakdown. We're limited on our room to roam because of this area of demand down below us. But this area of demand down below us is not the strongest area of demand, right? So since this isn't the strongest area of demand, it's already set as a confirmation. I'm okay if you take the breakdown, provided that we get a little bit of basing in here. Where would my target be on that? So if you get short on that 36.90, I think that you could see a realistic target of 35.68, 35.70. So I think you've got a good, smaller time period. If you want to go on the 1 hour, like where do I get long? Well, the answer for me is I don't get long at this point. I don't have any super clean longs in order to try to jump in and to time this market. I think that your breakdown is probably going to be the better setup and the better trade. Did any of you ride down the breakdown from? Oh no, we did it on Tuesday. So this was our Sunday night session. We talked about this breakdown. So hopefully some of you caught that. I see a similar thing that could happen in this one today. Gold. So in our gold level yesterday, we had a little 15-minute level that I thought we might get a bit of a reversal on. After we saw this very big, strong move up, we came back down into the level. 1, 2, 3, 4, 5, 6 candles later, we had gotten below the pivot, so we got to stop out about 4 candles into the 6-candle move. Wasn't really going anywhere. A little bit surprised with that, frankly. I thought that actually would serve as a decent little bounce location. So now I'm going to look up to this area here, 1936 by 1963 by 1967. I think is the next potential reversal point if price makes it up to there. I wouldn't actually be surprised to see a little bit of a breakout up to that region and then a reversal in that zone for gold. All right. So that's our crude oil and gold. And I don't normally cover all of these commodities in every live or in every session, but I want to just review them real quick. We looked at a nat gas supply level on a 15-minute. Price did come back up into that 15-minute level. We got a little move away. We then started basing here below the breakout and then got our breakdown trades. So You may have caught a little bit on the reversal. If not, then hopefully you were able to catch the breakout trade for price to kind of come down from there. And I think there's still opportunity for price to come down even further. So if you missed that short, I think you may get another opportunity to get short on another breakdown in here somewhere below 2.288. We talked about copper yesterday. We're still in between our copper zones, 2.9557, 3.0931. That would be our areas of support and resistance. That's kind of a trend channel we've been staying inside. Staying inside that sideways trend channel on the 4-hour chart. It's very obvious to see the sideways trend channel, the band that we're in. You can certainly trade between those areas, but know that your risk is a lot higher when you trade between those kind of sideways price areas. If you get a decent pullback, we've got, I'm going to go with this one here. There's really 3 choices. This was the one I first was drawn to, was this wick over wick, but this long wick up here kind of took me off of that, because that means we came up and then back down, and I bet you on a 15-minute chart it'll be easier to see. There you go. It's much easier to see that that was a clear retest on a 15-minute chart. So the next one that I was considering was this one right here, and then there's this one down here. Now this one down here is the one that I first would go to, but the time of the day on that one is very weak. So I'm coming up a bit higher and looking to this area here, 2.9963, 2.9877. All right, so I'm going to take a look at that one. Yesterday we talked about a breakout in corn. So we did get our breakout trade in corn. Did anybody take the breakout setup in corn? We didn't get super close basing, but you got fairly close basing at the level. If you didn't take that, then you got a little bit of a retest back to the breakout area, and we've gotten a decent move away. So if any of you caught that corn move, I'm going to remove this line. And now if you want to take a further pullback entry, you've got this little wick over wick that's right in there, 364.97, 364.19. And then the last one was soy. We talked about this level here in soy yesterday. I think that was on a 15. I just didn't do it the right color. Yes. So we came back in. We got a nice retest. Price moved away for about a 2-to-1, 3-to-1 move. We then came in a second time, and you got a confirmation entry if you wanted to take that, and got a decent move away. So soy and corn, both levels, breakout trades were fairly effective on there, and you got some pullback retests. If I'm looking at soy today, this area here is actually still pretty good on the 1-hour chart. 980 by 974. All right, so any questions on commodities before I shift away from our commodity markets? Oops, wrong button. Before I shift away from our commodity markets, does anybody have any questions about our commodities setups? And I'll post this in there. Now's the time. And ask the questions. All right, and then let's go to bonds and currencies right quick. And I'm going to jump through these ones fairly quickly. Yeah, absolutely, Steve. Shoot me an email. Just send it to chuck.fulkerson at tradersarmy.com. Absolutely. So just shoot it to me right there. So I don't know why I just put my thing in red, but that's my email address if anybody wants to email me. Let's see. So looking here at our bonds and currency markets, yesterday, not a whole lot happened. We took off. We actually had a demand level here in the bond market yesterday that I took off, and then all of a sudden figures it worked out just fine. So that was my demand level that I had in the bond market yesterday. I took that one off, decided it wasn't worth the risk. We did wind up getting a little bit of a move out of it, so some of you kept it on your charts. Hopefully you got something there. I don't want to add anything to today. I'm going to leave it kind of as it is. We've still got some good supply above us, some decent demand below us, but everything in between is kind of garbage. Next, the Aussie. So in our Aussie position, we did rally up into this level. Now, this level that we had looked at yesterday was really based off this 4-hour supply and got a really nice move away from there, off that supply area. Very strong move. Matter of fact, to the point that it came all the way down to our 15-minute demand. And then off of that 15-minute demand, we got a little bounce, and then it fell right through. So 1, 2, 3, 1 right here, 2, 3, 4, 5. It was 6 candles later, and we were basically back to where your entrance would have been. If you stayed in it a little bit longer, your stop out was soon to follow. So 6 candle rule is there for that particular reason. But now, looking at our 4-hour, what's our 4-hour telling us to do? Somebody type in the chat box if you would. What is our 4-hour giving us very explicit instructions on? Because it's not, it's definitely telling us, it's given us very, very explicit instructions to kind of be meh, to not do a whole heck of a lot. There's not a lot in there worth doing. And so I think if you wanted to do something with this, it's got to be a candle-to-candle opportunity. This is a great reversal candle we're getting right now. But that's the only way that I would trade it. Looking at the euro. So our euro supply level yesterday also got a very nice move away in our euro supply level. It was a little bit too strong, though, because then it blew right through our demand level. So euro supply level blew right through our opposing demand level. But I want to show this real quick. So here we have a gap. Here we have a price gap. Hopefully you guys caught that euro level, and then maybe you got stopped out on the other one. The winner was much bigger than the loser. Here we have a euro gap. So there's 2 ways to play this gap in the euro. One way is as a gap and go trade. And now why did this gap occur? Can anybody tell me why this gap happened? Okay? And this is important when we're trading futures. What was the reason that this gap occurred? Very good, Liz. It occurred on rollover. So if you're trading with a broker, or if you're trading on a platform that stitches together the contracts in a way that you don't see the gap, what happens then? You miss out on the gap opportunity. Here's what I'm going to tell you. Historically, when I first traded futures, I was told, well, don't pay any attention to those gaps. They don't matter. Let's use a platform that stitches them together so you don't see any rollover gaps. I find that to be incorrect. I actually think that this rollover gap is a really good trading opportunity on a retest. Because if enough orders have piled up in here, you're going to see that this becomes a decent opportunity to buy. The other thing is that this became actually a really good gap and go trade. For those of you that trade the gap and go scenario, this gave you a gap and go setup. Now, we trade the gap and go setups on Sunday nights because that's typically when you get your futures gaps. But you are also going to get rollovers gaps. And so for those of you that traded that Z contract, immediately you had an opportunity up here. So I'm going to leave this rollover gap line marked because I still think it's valid. And yes, I know that the Z, if I look at the contract specific, that I won't see that gap, right? That gap isn't there when I look at that contract specific. But the gap is there when I'm just looking, when it goes from the U to the Z. And so I'm okay playing that rollover gap. We've seen it happen time and time again in our live trade rooms that these rollover gaps matter. In the Canadian dollar, so our Canadian dollar level, from what we looked at yesterday, we had looked at this area as a supply zone. Our supply zone level from a 15-minute chart, this was a while ago. We had popped through it, but we left it on, became a flip area of demand. So we saw that our demand level flipped. Our supply level here up above did poke through, and unfortunately there was no real strength there. And so what I'm going to do is remove all of these lines and then just go back to my 4-hour. When I go back to my 4-hour, what's my 4-hour trend direction? Right? This one's got a little bit cleaner of a 4-hour trend. And my 4-hour trend on this one is definitely still down. So I think if we get a good hourly candlestick setup on here, you can take a bit of a breakdown trade if this happens in here. Okay, if we get a bit of a breakdown, if we get the basing right through here. There is a bit of demand down here that's actually not terrible areas of demand. So in my mind, that's going to be your first target because you could see a bit of a reversal right down in here, but that would have to be a confirmation entry because we're in a sideways price action. All right, and then Great British Pound. Yesterday, we had a short on this pound and got a really nice move away. We then converted it to a confirmation entry. It came all the way down to our demand level. Now, our demand levels down below us, because of our 4-hour trend being so strong to the downside, have to be confirmation entries, and the market just popped right through them, like the proverbial knife through butter. And now we've got a level down here. I think this level here, while it's a demand level, I did not have an opportunity to get long on this because we bounced off of it without entering the position, without entering into the zone. So it doesn't follow our rules to get long. It does, however, set up for a potential breakdown. And the reason I'm looking at the breakdown is just due to the fact that we have all of those upper wicks here that are strong reversal wicks. So those strong reversal wicks might give you an indication to look for a breakdown below here if we get some more basing. Japanese yen, we have our 15-minute area of supply. We came really close to it, and we were unable to get in. It just did not happen. On the gap up, and then price traded higher. We didn't get in, so we need to take this based upon our rules, switch it to a confirmation entry, so that level is still there. It just switches to a confirmation entry. Okay. Now, I leave my lines on the charts every day because if I leave my lines on the charts every day, I don't need to go back and start fresh. How many of you, just let me know in the chat window or in the comment section down below if you guys are watching this on recording, how many of you leave your lines on the charts? How many of you leave your lines on the charts and don't take them off? Do you start fresh every day? Do you take your lines off every day and start fresh every day with your analysis? So Jeremy leaves his lines. John says, Louis says always leaves my lines. Good. Tom, I leave them sometimes. Carla says yes. Okay. And the reason that I ask is because I think a lot of people take theirs off every day and they start fresh. And I think there's a lot of value in leaving your lines on your charts as long as you can. Because now, once a level's been used up, then certainly it doesn't make sense to leave them on there. But the longer you can leave them on, the more accurate they're going to be. And I really think that not necessarily they'll be more accurate, excuse me, but they're still going to have validity when price returns back into those levels. And that's, I think, the thing to pay attention to and to remember. So, all right, well, that's all I have for today. If you guys have any questions at all, please shoot us an email, support@tradersarmy.com. My email address is just chuck.fulkerson@tradersarmy.com. I am here to help, anything I can do. And like I said, we'll try to go live a bit more frequently. So I will see the live trade room members on Sunday night, on our Sunday night session. Remember, Sunday night session, the first hour is futures. The second hour is options. It's really the best session, I think, of the week. And we are gonna get her done. All right, everybody. Hope you guys have a great day. I appreciate you joining me. Talk to you soon. See ya.